Thank you all for being here today and for spending your Saturday to learn about all things startup, fundraising, and all the amazing stuff you've had a chance to hear so far. I'm really happy to be here with this amazing all-female, I might add, panel talking about money, which is always ironic. So it's going to be a really interesting and insightful hour or so. So who am I? I'm Sana Kapadia, and I lead the funding and impact programming at Spring. Spring is a startup school for entrepreneurs trying to build a better business. And by a better business, I mean one that's not only sustainable in the way that it's built, but one that is going to be better for people, for the planet, and also leave a better impact on our world. We have some social handles if you feel like giving us some love too. So what I want to kick off with is just a little bit of an intro into the spectrum of capital raising. And so what we have here is just a graphic to kind of indicate the different stages that a business tends to go through, where you start off with trying to, you have just a concept, and how do you get this off the ground? For the most part, people tend to self-fund or bootstrap, or maybe get a little bit of money from friends and family. And as you go through the motions, the pools of capital evolve as well. And so when you're validating, there might be some government money or some grants or different programs. And I think you've had the opportunity today to hear from Eric at Boast about some non-dilutive funding options. And I encourage everyone to explore those, because it's pretty amazing how many resources there are here in Canada for entrepreneurs across different you don't only have to be a tech entrepreneur to be eligible for some of them. There's all sorts of different pots of capital. And then we get into the realm of angels and some early seed stage capital, maybe some seed funds. Sarah will be talking a little bit about the seed fund that Pangea has as well as some of the other venture capital options. And then we look at maturity, where maybe you have an IPO at the end of the tunnel, or maybe you have other sources of debt financing that start to be available. So this is just to give a lens of the types of capital, but I think the other key takeaway from this slide is that at any given point in time, it's important to recognize that there are various forms of money to tap into. And so when we ask entrepreneurs, do you need to raise money? Everyone puts their hands up and they think it's only equity. And I'd like you to remember that the goal is for you to raise the right type of money for your business at the right time, and to really develop a strategic capital raising plan that allows you to pool all these different types of funding as it fits your business. This is just to give you a little bit of color on focusing on equity, because that's going to be the bulk of what I'm going to be talking about today, and the other panelists too. In terms of the different types of paperwork that's been used for equity rounds since the 90s. And we started off very, very simple, just common shares. We've seen convertible bonds enter that arena. We've seen convertible bonds with caps. We've seen SAFE agreements. Most recently, Series Seed pref agreements. And this points to the increasing sophistication in both the investor and the entrepreneur mindset, but also that these are all just conduits to capital. So it's important to educate ourselves on what these different types of paperwork look like, and also to recognize that at a certain stage or at a certain type or amount of money that you're trying to raise, one of these might be more appropriate. But this is just to give you a canvas of how things have shifted in the last 20 to 30 years. A little bit more on trends, and this points to some of the tech deals that have happened in Canada, zoning in specifically on Canada. I'm going to move closer so I can read this. Tech deals have gone up almost 50% since 2011. And the average, thank you, the average VC deal last year was about $5.8 million, the highest since 2013. An interesting thing to zone in on is off the top 10 deals done in 2016, most of them, 63%, were early stage deals, with the remainder being later stage. So for all of you in the room who are starting out and you have this complaint or hear this complaint from entrepreneurs that there's no money, this helps to shatter that myth a little bit. There is money. It's about finding the right money and about finding values-aligned, returned investors who are able to help you on your journey. Another key thing I think to point out is that there is increasing cross-border activity. Here in Vancouver, we tend to think, okay, we are Vancouver-based companies, we may have a global market, but we're going to start out by only looking at our own little pool. I think that today we live in such amazing, connected global times that I encourage people to start to think, okay, where else is the right investor for me? If they're not here, let me start looking at where they might be. So that trend is also on the up. I'm going to spend a little bit of time talking about the process. And so we have to start this journey when we're thinking about raising equity as to how much we need and by when we need it. And so there's some numbers that we should start to become comfortable with. So by how much, how are we going to get to that? Think about how much you're burning through. What's your burn rate? How much runway do you have? How long is that going to last you? And then to really come up with a plan that helps you, figure out, okay, where is this money going to go and what's it going to help me achieve? So really building out that plan is one of the first steps as part of raising money. Other things to keep in mind as we start this process is think seasonality. So let's say August, mid-December to the beginning of January, super hard to raise money. People go on holiday. People have other things that come up. So just bear in mind seasonality as you're starting to plan for raising money. I alluded to this a little bit. Start to think about your ideal investor. Where does that person reside? What type of experience do you need them to have? What type of return alignment should you be thinking about? Bear in mind geographic differences. Trying to raise money in Vancouver happens at a certain valuation, for a first-time entrepreneur trying to raise money. That could be very different if you start to look at the value, where the expectation is that you raise more money at a higher valuation. So kind of bear in mind geographic differences. Line things up. Pick your startup lawyer. It's great through this network that you've had a chance to hear from some legal voices in the community, from other sources that you can get some information. Line some of that up so that you get your house in order before you start and get the process on the road. Your due diligence. Due diligence is, yes, it varies for where you're at, and we will touch upon that, but start to line things up so that once you're ready to start to talk to investors, you can just, get things going. We talked a little bit about paperwork, so think about the different types of paperwork that's available, but try not to get just wedded to a single thing. Oh, I'm just going to go with a common share agreement, or I'm just going to go with a convertible. Try and keep an open mind and let that conversation unfold as you start to meet with investors. Statistics suggest that for a seed round, entrepreneurs try to line up anywhere between 58 to 70 meetings. You end up probably talking to about 40 investors. So it's hard work. Prepare yourself for fundraising being a full-time journey and plan around that process. Pick your warm intros, again, through the network, through organizations such as ours and others in town where you can have some warm referrals come through. Try to line those up. And really connect with some advisors. And by advisors, definitely on the legal side, maybe with your incubator, but also go talk to an entrepreneur. If you do anything today when you leave this room, go and speak to an entrepreneur who's raised money in the last 6 months. Hear from them firsthand what that experience was like. Make them your friend and learn from their pitfalls, but also what went right for them. And just a little bit on the back end. So now you've started to talk to investors, things are going well. It's really important to remember that it's just as important to work on the business while you're trying to fundraise. So don't forget the full-time business that you're trying to run and create, because they're both full-time jobs. So let's try and line up some milestones that we're going to try and hit as we're trying to raise the round. Remember, everyone has a lens. So angel investors particularly, they're individuals. You talk to someone who has a marketing background, they're only going to want to know how you're competitively positioned or how you're going to really increase that presence. Talk to an accountant, it's going to be very different. So just bear in mind that context. The goal that you should be aiming for is to get at least 120% of what you're looking to raise. Why do we say that? So that if things happen at the end, like someone starts to pull out, someone needs to go climb a mountain and is like, sorry, I can't do this anymore, things happen, so prepare for contingencies. And once you get to 50% in, that's when we can start to put a little bit of urgency as, okay, hey guys, or hey ladies, we have about 30 days to close, let's start to get this moving. And so there's tips and tricks around negotiation that we can share as well. And maybe just to end, what I'll say is that at the early stage, equity investors, particularly angels, all they're really trying to understand is, do I like you? Do I like you as a CEO? Do I like you as the founder? Do I like what you're doing? Do I think your team is the one that has what it takes to really take this idea to fruition? How are you different? How big is the opportunity? How are you going to sustain yourself in the competitive landscape over time? And how are you going to make money? So how are you going to make money is important to understand how your business works, and how are you going to make money means how am I going to make money? So just simple framing of how investors think. And at this stage, I guess Jill would go next. So.
Can everyone hear me? Okay, great. Okay, how's everybody doing? Saturday afternoon, talking about capital. Here we are. Okay. So thanks, Sana, for setting the stage, because I think that's really key, and that really I'll build on some of that. So I'm Jill Earthy. My title is Chief Growth Officer, which is kind of fun, of Front Funder. We're a financial technology company with an online investment platform, which I'll talk about in a minute. But I'm here sort of with a few different lenses or perspectives. So my background is I've had a couple small businesses that I've grown and sold. So I've been in your shoes. I've raised capital, small amounts, but I've raised capital. And then I actually was in the nonprofit sector for many years. First as the CEO of the Forum for Women Entrepreneurs for 5 years, so helping entrepreneurs access the resources, including capital, mentorship, and education that they needed. And then I was with Futurepreneur Canada, another national nonprofit helping young entrepreneurs access financing and mentorship in the form of a low-interest loan. So, and I say that because I know you talked about some non-dilutive financing before, so I always look at the whole picture with a whole funding puzzle that Sana mentioned as well. And I currently serve as chair of the board of Women's Enterprise Center, which is a provincial nonprofit that provides financing up to $150,000 for women entrepreneurs, sorry guys, as well as additional resources. And just because we're in the SFU building, I should mention I'm also on the board of governors for SFU. So those are sort of the lenses that I'm, a lot of different perspectives. So let's just talk a little bit more about what Sana mentioned around that funding puzzle. And I'll just reiterate a couple of points, because I think that it's so key that you do need different types of capital at different times, and to make sure you are exploring the options. Who has raised capital before? Maybe you did this earlier, so a few of you. Okay. And those of you who, even if you have not, it's a bit daunting, right? So many different options, so many different sources, people giving you all different types of advice all the time. You just kind of sometimes want somebody to say, what's your plan? Well, we can't do that. But I think it is really key, first of all, to think about why are you fundraising, right? Sometimes you get that pressure, like I have to raise funds. If I'm going to grow, I need to raise funds. And in some cases you do, but I think it's important to take that step back and think like, why? What are you going to use the funds for? How's that going to drive your business forward? And is that going to achieve the goals that you want? How much risk do you want to take on? All of those things. So really consider your why. And talk to people. Again, as I said, really talk to people. People in your network, people who know you, who understand what you're capable of and where you're going to take your business. Talk to advisors, and definitely talk to entrepreneurs who've been there, done that, and have experience. Oh, sorry. I'm reading the wrong, okay. So talk to people. And again, that debt equity mix. What is right for you right now? And what impact is what the type of money that you raise now going to have when you raise money in the future? And Sarah will probably speak a little bit to that too. But that mix is key. And make a plan and really be prepared. And look ahead a little bit if you can. I know we don't have those crystal balls, but we do need to think, where do we want to take this business in 2 years, 3 years, 5 years? In some cases right now, things are moving so fast, even 6 months. And what does that mean? So, and be prepared. I cannot emphasize that enough. I think all of us, and those of us who service entrepreneurs, the preparation is so critical. And there's so many great programs like New Ventures BC, and the reason you're all here today, to make sure you're prepared. Because I know I talk to probably 15 to 20 companies a week, and a lot of them are just not prepared, don't understand what it actually means to raise capital, don't understand the why, and certainly don't have their financial house in order. So that's really key, and people want to help, so reach out. So really think about, what does your funding puzzle look like, specifically for you, your needs, and your goals. And the other piece I wanted to make, and the reason there's different puzzle pieces, is because we all want to work together. Right? So at Front Funder, we work with financial institutions and traditional non-dilutive sources of funding. We work with angel groups and other types of investors, because it's really about how do you find that right mix, and we actually all talk to each other. So you're not always having to talk to this person and then individually go talk to this person. The other key piece is you don't have to choose one path and just keep going that way, right? There's ways that we can help you along that route, and that you can combine sources of capital, and we will talk to each other to make it easier for you. So I'm going to talk a little bit about some of the new models that are emerging. Angie mentioned briefly, but one of the reasons I joined Front Funder about 18 months ago, because I, as an entrepreneur, and talking to so many entrepreneurs, really saw there was this gap in the marketplace. And then on the other side, I got really excited because I'd started to do some very small investments myself in some companies that I believed in, and opportunities that I never thought were accessible to me before. You know, I've been a nonprofit. I mean, I had a little bit of cash that I wanted to pay forward, but was not an angel investor, never identified as an angel investor, but thought, okay, there's maybe an opportunity for me to start to put some money to work here. And had someone hold me through that process the first time. So when I identified Front Funder, I did not found it. We have an amazing CEO, Peter Paul, who was the visionary behind it. He came from Europe, where new models have been emerging around capital raising for a while, and had this vision to unlock capital in Canada for early stage and growth companies. And I'll tell you how. But to really create some accessible channels connecting companies with investors and bringing that through an online process to make it way more efficient. That's really the key. You're all busy. It does take a lot of work. It does take a lot of time. But if we can make it a little bit simpler to connect those dots, then that's why we're here. So who's here heard of Kickstarter, Indiegogo? Who's bought something through those? Great. Fantastic for pre-sales, fantastic for validating market. And it's a great testing ground, or sometimes making a donation. So what's changing in Canada right now, we have a lot of those sites. Those are donation-based crowdfunding sites. But the next level that just started in Canada about 2 years ago is that equity crowdfunding. And we actually don't even really use that term, except that I have it on the slide. It's more online investment in smaller private and early stage companies. Because I think a key distinction here is we are a regulated financial services firm at Front Funder. And so therefore, we use any type of security. So we can do debt, so convertible notes that Sana had. We can use safes for companies raising capital. And most commonly, our common shares. So equity or debt, any type of security through our platform. There are different platforms across Canada that exist now, which is great because we are unlocking that capital. There's some just focused in crowdfunding, so they're mostly non-regulated. So companies, small companies, can raise up to a certain amount of capital because there's some new rules in place in Canada, which I won't get into, but can answer in the Q&A, that allow companies, certainly in BC, to raise up to $250,000 in capital. And investors, smaller investors, can invest through that. Then there are other platforms in Canada that are just for accredited investors or high net worth individuals, or angels, where you can go through that platform. Where Front Funder fits in, we are a regulated exempt market dealer, meaning we use all sorts of prospectus exemptions and have that hybrid of allowing companies to have those strategic investors that are so critical, so those larger strategic investors who are maybe going to have a board seat, provide some advisory services, but as well as topping it up with some of the smaller investors. So that power of that foundation of those bigger investors, but also that having some brand champions too. But sort of an interesting trend that's happening now. So platforms like Front Funder and others have been in the UK for many years now, about 8 years. In the US for about 5 or 6. So we're starting to see some interesting data emerging around this. This is what's happening. And it's just a bit newer in Canada. So these are just some stats just showing how about 2 years ago that, well actually 3 years ago, that cross-section where crowdfunding or online investment actually exceeded private equity. So just interesting. So I mentioned Front Funder. We're nationally registered, and it was important for us to go down that step early on, work with all the regulators across Canada, and some of you may be familiar, there's one in every province, so it makes it very fun. But our goal is to streamline the process, make it simple, and help companies like yourselves navigate that regulatory diversity. We're a curated marketplace. So every company that we work with goes through a very thorough due diligence process. Sana mentioned the importance of that. We help guide companies through that process. It's very collaborative, but we look at certainly the people behind the companies, the directors, all of them. We look at, obviously, financials, key piece. We look at the business model. We look at valuation. And we look at use of funds. How are you going to use the funds to move forward? Is it enough money that you're asking for? Or is it not? So really questioning that and coming up with a solid plan. Then the companies that we work with go up on our platform eventually. They go through an investment review committee too, go up. So it's very thorough. And our whole goal is to mitigate risk for the investors and to position the company for success to a broad range of investors, which makes it very powerful. And then to simplify the process, we put it in an online secure environment so that as investors come in, they can access information to do some of their own due diligence if they want to, or if they're making a smaller investment, might just go with their gut. We've got a proven model and traction now, and it's really about unlocking funding for companies and, as we say, democratizing the whole process, really opening it up. So it's that combination of the accredited investors, the family and friends. We process a lot of family and friends as well through ours. We act as that sort of independent third party, giving additional credibility to companies, retail investor, and then other. So that can be non-dilutive financing, or other sources could be venture capital, it could be a combination. But that's the power, is bringing those different groups together. So it's really changing the landscape. Talked about democratizing. So that social impact too. I'm going to share some examples of that in a moment. And the networking effects, that sort of paying it forward and having that ongoing effect. And it's about making it way more simple, way more transparent. We're really trying to change the way capital has been raised in the past, behind closed doors with only a few people getting access to those deals, but cracking it open, making it more simple and way more accessible. So let's just talk about a few stories. So these are some examples. Of course, the best way to learn is through examples. Any of you heard of any of these companies? Ripen. A lot of them are homegrown here in BC, which is fantastic. So I'll just share a couple. So Persephone Brewing Company, craft brewery, really cool company with an organic farm on the Sunshine Coast. So they had a mission to raise about $500,000, or maybe I can't even, yeah. Nobody can see that. $500,000. They exceeded their goal, but they had two goals. They had a goal to raise capital to actually grow their operation and increase their distribution, but they also had a goal of engaging their customers. There were a lot of their customers who love their beer and want to pay it forward. Their minimum investment, $100. So they opened it up. So they had a combination of some larger strategic investors, as I said, but then they had this whole group, almost 200, of smaller investors who made an investment anywhere from $100 to $2,500. So they achieved their goal of getting those brand champions. So now some of those people, when they go out to the bar with their friends or they're buying beer, they're like, you have to buy this, you have to buy Persephone. So they basically had people pay them to promote their brand. So it's pretty cool model, and they're doing really well. We've got Peak Fund, actually, which is interesting. So a fund, some of you may know Bonnie Foley Wong, who's based here in Vancouver. She's a social impact fund focused on women in tech, well, primarily women in tech, who are doing a difference. She's invested across 6 different companies through her fund. minimum investment is $5,000, so a little bit of a different blend. But she's just come back on our platform. She's just launched again because she had such a great experience because we were able to increase efficiencies, help broaden her reach to engage more people to participate. And now she's back. And she's actually, so that investment now is just open to accredited and friends and family. But that's an example of the diversity of deals that we can do. We listed ourselves on our own platform. Had to walk the talk, had to prove it. And we were just raising $500,000. We raised $650,000, engaged just over 200 new investors. And it was really fun and really good learning for us. So we have a blog on our site about some of that learning, which is good. Hitch Planet, which is now Papa Ride, that was really interesting, $250,000, mostly from their customers. They're a long-distance ride-sharing platform, so they had customers who were engaged in their product, who used their app and their service, who wanted to participate and are now going to be able to do that on the long term. Another interesting one, Impact Finance. I know some of you may have heard of that. We had them on at the end of last year. They closed in December. They are setting out to create an alternative bank. They're a Quebec-based company. They have a very bold mission, and they raised about $1 million, just over $1 million, 800 investors. So it's the largest deal of this kind across Canada to date, which is actually about to shift. But it was marketing, it was the capital. They did a fantastic job. And we actually just this week launched another one on our coming soon page called Red Mountain. It's a local ski hill in Roslyn, BC. It will be the first cross-border fundraising through 2 online investment platforms. So we're the Canadian partner, Start Engine is the US partner, and they already have $12 million reserved. So that's pretty exciting. So they'll be going live in July. iHeart, anybody seen Sarah Goodman present? Really interesting local female tech entrepreneur. She's doing phenomenal things. She and her dad have created this great company that tests your internal age, which can be good or bad. I did it last week after 2 cups of coffee, and I was 5 years younger inside, so I was happy with that. But they're really doing really well. They have obviously a technology play using an app, but also have a hardware piece for the fitness industry primarily. She is currently on our site, a minimum investment of $250. So interesting just because you're like, okay, I can dip my toe in. And that's one of our missions is how do we engage more Canadians to just dip your toe in? These are high-risk investments, I should mention, but it's kind of empowering to be able to have the opportunity to invest in companies you believe in and see them succeed and pay it forward and ultimately see a return at the end as well. So really quickly how it works. So it is about that education, that understanding up front, as we've all spoken about, preparing your campaign, because it's also about any type of fundraising you're going to do. It's about launching what is your story, what is your mission, packaging it up in the right way to be able to tell that story, going through due diligence, making it happen. Most of the companies that we work with, typically it's 3 months, and I know fundraising can range, and sometimes it just drags on and on. So it's part of setting up your plan, and then it's about celebrating your success at the end and really bringing on those brand champions. So I'm happy to answer any additional questions after. Maybe we'll do Q&A after, because Sarah's going to do the next continuum of the fundraising spectrum. Thank you.
All right, can you guys hear me? Is this on? Yeah? Okay. All right, so I'll just round out the session on venture capital, which is more institutional, sophisticated capital for businesses that are starting to raise larger amounts of money. It could be anywhere from sort of $500,000 that might be compatible with a crowdfunding platform up to $5, $10, $15, $20 million or more. And just to get a sense from you guys in the room before I tell you a little bit about Pangea, what we do, and a little bit more about venture capital, in your business plans that you're developing, how many of you intend to raise venture capital? Show of hands. So like at least half of you. And maybe can I just ask a couple of you guys to shout out why you want to raise venture capital? Growth? Okay, that's the primary reason. All right, cool. So for those of you that are interested in raising venture capital, there are a lot of reasons why funds are a great source of capital for you, but I also want you to keep in mind that venture capital is actually the most expensive capital that you can access to bring into your business. So I want you to keep that in mind with Sana and Jill's presentations, and I'll go through mine quickly. So fundamentally, what is venture capital? It is private money for early stage, high risk, high reward types of investments. And in exchange for this capital, the investors will acquire an equity stake in your business. So it's really looking for a partnership opportunity, essentially, in exchange for that investment. Most venture capital firms like to be fairly active investors in the companies that they choose to work with, and that can take the role of, or take the shape of being involved at a board of director level. And then lastly, sources of capital for venture capital funds include the fund founders, high net worth individuals, investment funds, private corporations, pension funds, and others. But I know you guys had a session a couple weeks ago on angel capital, and I just want to highlight sort of what's the difference between angel capital and angel investors and venture capital. And I don't have a really great image for venture capital, so it's this guy in a suit holding a bag of money. But the fundamental difference between angel investors and venture capital firms is angels are investing their own money. And so how they look at an investment opportunity can be fundamentally different from how a fund might approach it. And they are, at the end of the day, only accountable to themselves. Whereas a fund has a specific mandate, they have investors, they have partners, and an investment committee that they need to be accountable to at the end of the day. And both Sana and Jill talked a little bit about sort of the due diligence process, screening, and sort of how companies get through their platform to access capital. And the venture capital process looks very similar, but I'd say almost a little bit more selective. So at the top of the funnel, you've got global deal flow. This is every startup company in the entire world that is raising money. And where we kind of get involved is the second level screening. So at Pangea, and I should actually give a little bit of background to Pangea. We are a venture capital firm based here in Vancouver that invests in companies that have material science, chemistry, or biology technologies at the core of what they do. So we really focus on companies that are like hard science companies. We're not doing digital, we're not doing sharing economy, we're not doing anything in pharmaceuticals or drug development. We recently launched our fourth fund, so we've been doing this for over 15 years. We launched this fund in December, targeting $100 million US fund size, to invest in companies in two stages. I run our seed investment program called Pangea Spark, where we invest in early stage science companies that are really focusing on high growth, fast moving markets with truly disruptive technology. And then the rest of the fund and the rest of the team focus on companies that are already further along in their commercialization cycle and invest in companies that have product revenue. And so for us, the second tier of the funnel screening, this is every deal that we physically talk to, interact with, meet the management team, and we see like 700 new investment opportunities on an annual basis. And only about 10% of those move on for further due diligence. And by further due diligence, I mean we spend some real time with the management team. We look at their technology, we look at the market, we could be going through their financials, reading their patents, assessing the competition, and this is getting up to sort of the investment committee partner level where multiple members on the team are doing some work here. And then we get to the term sheet phase. And the term sheet phase, I know you had a legal session this morning, is basically setting out the framework for what this engagement and this relationship might look like. We've both done due diligence on each other because don't forget we're getting into a relationship, a business relationship that could be fairly long-term, 5-6 years or more. And so while we're evaluating the technology and the business opportunity and the team is also evaluating the investors. Are these people that we want sitting on our board, working with us and weighing in and informing the strategy of the business? And so we'll issue a term sheet on a very small fraction of deals that we believe fit our investment mandate, we like the valuation, and we think they're a fit for our portfolio. And then, even if we issue a term sheet, that's no guarantee that the investment will be consummated and the deal will be done. And so we really only invest in 0.5% or less of all of the deals that we might encounter. And so it's a fairly competitive process. And as I think Sana said earlier, have a pipeline of 30, 40, 50 investors or more, both for angel investment as well as when you start to scale and start talking to venture investors, because it is very selective. And not being successful with one investor is not a knock on your business, but all investors have very specific criteria and see a very high volume of investment opportunities. And so let's talk a little bit about getting a deal done. After all the due diligence is completed, you get to the term sheet, what comes next? And the investor is the one that's going to issue the term sheet and tell you as the entrepreneur really what they think what your company is worth. This should not come as a massive surprise to any investors in the room when a term sheet comes to the table, because both you and the investor should have had some conversations along the way around valuation. How much have you raised to date? What has the share price been for the prior rounds? And what are your expectations for the valuation of the company, both at this stage of the business, but also in 2 years when you need to go out and raise some more capital? What is that value inflection point? The term sheet is also going to contain some more information, such as the amount that the investor is going to be investing, the type of the investment. Is it going to be a convertible note, which is effectively debt that converts into equity in the business at a later date? Is it a common share? Is it a preferred share structure? And what are the rights that go along with that investment, such as board representation, liquidation preference, which means who gets paid out first in the event of an IPO or a company sale. And of course, it will contain the valuation of the company, as well as any other subjects. Just as if you buy a property, put an offer on a home, you would put some, maybe not in Vancouver, but in other markets, put some subjects in. You need to do a little bit more due diligence before you can close, like do a home inspection, kick the tires, and do a little bit more work there. And I just want to spend a little bit of time talking about valuation. As an investor, I always get a lot of questions from very early stage companies, or really any company, around how do I value my business? How are you coming up with this valuation? And I just want to sort of preempt some of these questions. And so, there are a number of different methodologies that can be employed to come up with an appropriate valuation for a company. And Norma, in her session, mentioned that they use the NPV financial model to come up with a valuation for their business. And I would recommend doing a number of these different exercises as you begin to think about going out to raise money, because you'll come to very different results. And I think the most relevant one, ultimately, when you're starting to talk to investors, is comparable transactions. And by comparable transactions, I mean looking at other companies that are of a similar stage as you. How much have they raised? What has their valuation been? And companies in your market that are in the same industry, same type of technology. How successful have they been at raising? What have the valuations of those transactions been? And then also looking at company valuations on exit, whether that's IPO or acquisition, because any investor is going to say, okay, if I invest $1 million in your business today, what is the likelihood that I will get a 10 times return on this investment or more than that? And by rule of thumb, most venture capital firms are looking for that 10x or 10 times return on capital because of the risk profile of the asset class. Yeah?
If the company have a new technology, or if there is no comparable transaction, because actually there is no 100% comparable transactions. It's always there is a difference. Let's say there is no comparable transaction. So how they value at this point?
Exactly, great question. So just to repeat the question, if I have a new technology or I'm entering a new market, how do I look at comparable transactions? Because there really aren't. And I only have one more slide after this, actually, so maybe we can hold all the questions and open it up. There are always comparable transactions because there are adjacent markets that are similar to the one you're looking at, or newer technologies or similar technologies going into different markets. So think about stage of the company, the risk profile of your business, and the size of the market. And there are some really great resources out there to look at comparable valuations. AngelList, while it's mostly US data, you can access Canadian data on there. They publish the aggregate valuations of all the companies that have ever raised money on their platform. You can break that down by year, by quarter, by where the company is based, the market they're in, what incubator or accelerator they came out of. So you can go to angellist.co/valuations and look at Launch Academy companies, for example. So any companies that came out of Launch Academy here in Vancouver, they'll show you the average size of the investment as well as the valuation for that. But yeah, there are other financial ways you can come to valuation: discounted cash flow, NPV, like what Norma demonstrated. and then sort of that back of the envelope venture capital math method, which is if I invest $1 million today at a $5 million valuation, what's the likelihood this company is going to be acquired for $60 million or more, because that's what I need for my 10x return. But Norma also made this point. It doesn't really matter what your valuation number is, because the company's really only worth as much as somebody is willing to pay for it, and not a penny more. So you've got to keep that in mind when you start talking to investors and thinking about what that exit opportunity ultimately is. And I just wanted to leave you guys with a couple of suggestions, tips, tricks, and sort of lessons learned from the companies that I've seen along the way. First, most important one is do your homework. Really understand the investors that you're going to talk to, and make sure that you understand not only what their investment mandate is, because every fund will have specific technologies or markets that they invest in, or they have specific stage requirements. At Pangea, we only invest in companies that are seed stage or have product revenue. If you fall somewhere in between that, we're not going to be a fit for you. And your time is just as valuable, if not more valuable than ours, and so you want to be careful that you don't sort of go down a path chasing investors that are never going to be a part of your financing. That said, always have a conversation, and you can preface it with hey Sarah, I'm doing a software company. I know this isn't something that's in your world, but here's what we're doing. Do you know anybody? Always ask that question, and we would be happy to make some suggestions of people you could approach or make introductions if we can. Financing also takes a really long time. Fundraising, as Jill said, can be 3 months, 4 months, 6 months, or more. Make sure you're raising enough money that allows you as the CEO to focus on your business for at least a year. We generally like to see companies raise anywhere from 12 to 18 months of cash runway so that they can focus on growing their business, achieving their key milestones, so the next time that they need to go out and talk to both their existing investors and new investors, there's something new to say. You're able to say, we said we would do A, B, and C, and look at what we've achieved in this time frame with this money. We've been really capital efficient, and now we need to continue to grow our business and hit the next set of milestones. And lastly, you want to make sure that your interests and your goals as an entrepreneur and as a business are aligned with those of your investors. One thing I didn't mention is most venture funds have time horizons. We are at Pangea a 10-year fund, which means from the day we launched our fund, December 15th, 2016, we have 10 years to not only make all of our investments, but also exit our position in those companies, meaning that the company needs to have a liquidity event, so go public or be acquired or have some sort of other secondary transaction, because we have an obligation to our investors to give them their money back as well. And so you want to make sure that the type of business you're looking to grow both has the same time horizon and growth potential as what an investor is looking for. And with that, I thought this was a quick little funny cartoon that you all might enjoy, but I think we can maybe take some questions if we have time.
Okay, well, thanks first for the talk. All right. In case you didn't. All right, so I'll pass the mic for questions. If you three can share the lapel mics. Yeah, you can stand or sit, whatever works. Okay, I saw a question back here to start.
Kind of following on to your last point, wondering how it affects your valuation of a company coming in, if you want to invest in them or not, at the time they approach you during your fund. So how much money you have left and how much is reserved for follow-on capital. So if someone comes to you at like year 7 and you got to pay back the fund in 3 years, and they might be like a great company at your fund year 1, does that really affect your investment going into it, or would you like pass them on to somebody else?
Yeah, great question. So does the stage of company and fund life cycle impact our investment decisions? Absolutely. We would not make a seed stage investment beyond probably our investment period is only 5 years. So the first 5 years of the fund is when we make investments. After that, we don't make any new investments. We focus on growing and managing our portfolio. But when we look at the stages of the companies that come across our desk, we think not only how long is it going to take for them to get to market, get a product to market, how much capital is it going to take them to do that, and then once they get to market, how long is it going to take for them to get to an exit. And we definitely sort of layer that over our fund life. If a really, really exciting super early stage company comes across our desk, but we're 4 years into the fund, and we are very confident it will be 5, 6, 7 years before they can get to an exit, we're going to pass on the deal. We might track that company, and us saying no isn't a no forever. We might say, we're raising another fund. If you hit, these 4 milestones, we'd love to have another conversation. And here are some other people in our network that we think you might be a fit for.
Okay, so I have a question from Jill. Actually, about the front funder. What type of shares the investors are going to have? I want to know if you have 800 investors in your company. How's the AGM for such a company? Yeah.
Yeah, so how do you manage a large number of investors? So I think there's 2 parts to that question. So the first one too, so what kind of shares do they have? So it depends. So most companies, our term sheet that we work with the company on through the due diligence process, that stands for all investors. So whether they're writing a $100 check or a $100,000 check, and we've had the whole gamut flow through our site, their shares are worth the same amount in proportion to obviously their investment. To manage a large group of investors, there are a couple of ways to do it. Some of the companies we work with will set up a special purpose vehicle where smaller investors, so those investing, say, $5,000 or less, will be put in a separate structure, but tied to the main company. Otherwise, they'll use a voting trust agreement where those smaller investors, again, are pooled in that voting trust structure, whereby a director of the company would be their power of attorney or designate for that group of investors. So as the investors come in, they have to go through a process on our site too, to make sure they understand the risk, to make sure what they're, where they're based, which exemption they come in under. We set that expectation that if they invest a certain amount, that they will not have voting rights, but they are just happy to be able to be part of it. So it helps makes it much easier to manage. So there are structures to simplify that.
Okay, so my question is also for front funder, and it's along similar lines. We had speakers from Fasken Martino this morning, and they outright told us not to go down that path because they said that the moment we use something like front funder or OCMX, we lose the private issue exemption. Would you like to speak to that?
Yeah, happily. Was it Mike Stevens? I'll have to talk to him. So what there is in Canada, so there's a threshold. If you go over 50 shareholders, you lose private issuer status. But there's now, because of these new exemptions and these new rules with these online platforms, there's a sort of a middle ground where you do not become a reporting issuer, which is the key. You do not want to become a reporting issuer. Our whole goal is to help Canadian companies stay private longer and grow at a more sustainable pace. There is one very simple form that you have to fill in upon the completion of a raise called the Report of Exempt Market Distribution, where you let the regulators know who your investors are and you do not become a reporting issuer. So it's a key distinction.
I just wanted to add, so when there's a lot of companies that we've helped raise capital, and sometimes angel investors will say locally that equity crowdfunding, I'm not going to touch this. We just need to break that myth because frankly, it's here to stay. You saw the statistics. Things are changing. It's a new model of capital. And so if that type of investor, they're just not the right fit for you.
Thank you, Sana. But it's true. I mean, the challenge is it's still complicated, right? There's a lot of rules, and that's part of our guide. Our goal is to work with companies and investors to help understand it, because it is here. There are models in the U.S. and in the U.K. and other parts of Europe, and so we simplify it, but it's not like I couldn't explain and all the nuances in this conversation, but happy to chat individually about it. But yeah, there are ways to make it very manageable for companies at all stages.
My question would be a little bit about minimum viable product to take to market, and how would an investment firm or a capital firm look at how much money should be invested or could be for a software company to get to that stage, to just build that minimum viable product and take it to market? Kind of what would be way out of scope, or what would be kind of reasonable? If somebody could speak to that, that'd be great.
To understand the question, so how much money needs to be invested to get, like reasonably invested to get to a minimum viable product?
Sure. So a bit more context would be, for us, we're in software, but also content is a big part of that, video content, which is can be very expensive. So for us to maybe build a minimum viable product that we would feel comfortable of course, in the eyes of a startup and much different from you guys, we're thinking, well, how much would be reasonable? Like $2 million, is that too crazy for a minimum viable product? Should we go for smaller and then try to get something out there? If someone could speak to that, that'd be great.
Yeah, I can make a comment about the MVP. And I'm not going to specifically answer your question because I don't have an answer to that. But your MVP is what is going to enable you to raise more capital, right? It's what you show to investors to say, here's more than an idea. Here's how we want to roll out our platform, our product. Here's how it's going to work. Here's what the user interface looks like. Here's where we're going to source our content from and what makes it unique. And here's what we, now with this MVP, here's what we know we need to do to scale it up. So there's not a dollar amount that's appropriate, but it's what are the resources that you need to develop an MVP that can show an outsider the potential of your business, and whether that's human capital, equipment, or financial resources to do that. No outside investor or outside person is going to say, oh, you only invested $20,000 to come to that MVP. It's not a fit for us. Or you invested $2 million. That's too much. We're not going to touch it. No one's going to say that to you. You need to think about what's right for your business.
What I can add to that is that I think that this is where your plan is going to be really crucial, because agreed, there's no like, okay, this type of product is only 50,000, this type is only 100. It doesn't work like that. I think you have to think about what type of business are you trying to build? What do you really like? What does that need to look like? What's it going to take? What's that money going to go towards? And what's it going to help me achieve? So you need to start to think about that internally. And I think, just to reiterate the point that I made earlier, that it's not only just equity. To get to an MVP, look at those other pots of capital that are available to you. And this is where IRAP funding can be pretty amazing and has been for a lot of companies.
Yes, one question here. Maybe I misunderstood some information that we received today. I mean, at this time of the day, maybe suffering from a brain freeze a little bit. But I heard this morning that for crowdfunding, you can only raise $250,000 twice per year. And you mentioned in your examples that you had company raising way more than $250,000. So could you clarify that, please?
Sure. So as a key distinction, so we are a regulated financial services firm, right? So we are able to, we have access to a number of different prospectus exemptions. So the crowdfunding exemption is one of those rules in Canada, and that allows companies to only raise $250,000 twice a year. Individuals, depends on the province, but in BC can only invest up to $1,500. The key distinction for a platform like FundFunder is we can take advantage of all of the different rules. So we use a combination. So we use the accredited investors. So in most of the raises that we've done, they have angel investors or high net worth individuals have invested the large portion of those funds. And then we use friends and family. So some people will come in under friends and family, and then you add on the crowdfunding exemption. So it's that combination that together that makes it way more powerful. The one other rule I'll just mention is the offering memorandum that some of you may be familiar with, and that's so we would use those 3 exemptions as a combination, or we would then use an offering memorandum, which allows companies to raise capital from anybody at any amount across Canada, and a lot of companies are starting to use that. So it's the combination. We can take advantage of all of those. At the same time. Key distinction, at the same time. So some of those examples I used earlier, so some platforms that are not regulated are just using that crowdfunding exemption. So they are only able to raise up to $250,000 for companies. Others are just using that accredited investor exemption, so only limited to that 1% of the population in Canada. We combine them, and so we can really leverage that. And companies coming to us can choose, but typically they're using all of those together at the same time.
Hi, can each of you talk about what due diligence the management team can expect to face ahead of investments?
Sure, I can start. You shouldn't get any surprises on, what an investor is going to ask you for due diligence. So technology, market, we're going to want to...
Sorry to interrupt. I guess I meant the individual people, like assessing the management team, not the company. So the market, technology, that could be the company, but what kind of due diligence can the management team expect to face?
Well, I know for us, like we do searches. We have to do a director search on every individual, make sure there aren't any red flags that come up. So we look at that. We don't check credit score or anything. We don't have to do that on individuals, but we do have to do a deep dive. And then from the skills and experience, we do look at the objectives of the company, and is the team that's in place going to be able to execute on those objectives?
Yeah, the one other thing that we do, so yeah, it's the team. Do we like the team? Do we believe? Do we think the team has the right expertise and experience around the table to execute on the strategy? If not, has the team identified the gaps that they need to fill? And if so, are they open and willing to augment with new hires in order to do that? Do we like you? We're going to spend a lot of time with you. We're going to want to go for coffee after coffee, go for drinks, hang out, do a 3-hour strategy session in your boardroom or in ours to really make sure we understand your business and understand how you handle challenges and conflict and, having your business plan picked apart because we're effectively going to be, that devil's advocate in the room before we get to a term sheet. We're also not going to do credit scores or background checks, but we will do references. So we're going to want to talk to people you've worked with in the past, as well as your potential customers, to really understand, who you are as a person and how you want to grow your business.
And maybe just to add, I think due diligence starts even before you think it starts. So whether it's through a warm introduction or the first time that you're meeting an investor, like you may not be approaching them with the intention of asking for money, which is a good place to start. You're just trying to get to know the person, but they're kind of trying to get to know you. And to Sarah's point, coffees, it's going to be a process. You know how I said 40 investor meetings? You probably will meet each of those investors 3 to 4 times. So maybe it's not I'm here for due diligence, but it's happening anyway, so it can be subtle. And yeah, reference checks, I think, happen all the time, but it's also just as incumbent upon you as the management team to do reference checks on the investor and to ask what they're like to work with, because it is totally like marriage or a relationship. You want to make sure that, you can live with this for a while, at least.
And just to add to that, it is, when you get to a term sheet phase with an investor, whether that's an angel investor or a fund like us, or you get very close to that, always ask them for a couple references from their portfolio. We just did a deal 2 weeks ago, and before we got to the term sheet, the CEO, we'd known him for a couple of years, said, I'd really like to talk to a couple of your portfolio companies to understand the value that you bring to the table, how you've liked to work with them, and how you are involved with management and on the board level. And we're more than happy to make those introductions.
Okay, last call for questions. Oh, up here.
Awesome, thank you. I had a quick question on the tax credit, the EBC tax credit, especially for you guys, the funder. How does that work for you guys?
Yeah, absolutely. So we're, just to be clear, we're an intermediary, right? So when the companies come to us, a lot of the companies we work with are an eligible business corporation. Does everybody know what that is? So you can apply to the BC government and get eligible. You can become an eligible business corporation, which allows you to offer the investors in your business a 30% tax credit. So a number of the companies, BC-based companies on our platform, do offer that as an incentive to investors. We verify as investors come through whether they're eligible for that. Sometimes companies will set a threshold that, for investments of at least $5,000 or $1,500, then they would process the tax credit. And we help with that. Also for RSP and TFSA investments. So we also process a lot of those too.
Awesome. And success rate for front funder, are a lot of projects get actually funded or no?
Yeah, so the typical success rate based on other markets is about 50%. We're sitting at about 65% right now. Awesome. So, but numbers are still small, right? It's just coming up on 2 years. We've closed 11 deals. We have 14 companies in due diligence, various process right now. So we're starting to see the numbers multiply. It's really about that market education right now, but it's starting to happen.
Thank you. Awesome.
Okay, last call. All right. Well, thank you, all of you.